Borrowing and Debt Management. Introduction. Borrowing money has always been part of human society. From informal lending among family and friends to complex banking systems offering credit cards, loans, and mortgages, debt has played a significant role in shaping lives, businesses, and economies. For young people aged 18 to 35, understanding debt is crucial. This is the stage where many are pursuing higher education, starting their first jobs, running small businesses, or trying to become financially independent. Unfortunately, debt can either be a tool that accelerates progress or a trap that leads to years of financial struggle. This module equips you with the knowledge and tools to borrow responsibly, manage debt effectively, and teach others in schools and communities how to avoid debt traps. By the end, you will not only understand how debt works but also be able to guide others toward financial responsibility. 1. Understanding borrowing and debt. What is borrowing? Borrowing is when you receive money, goods, or services from someone else, a lender, with the promise to pay back later, often with additional charges known as interest. Borrowing can be formal, from banks, credit unions, or fintech companies, or informal, from family, friends, or moneylenders. What is debt? Debt is the amount of money you owe after borrowing. It is the financial obligation you must settle with the lender within the agreed period. Debt becomes a burden when repayments are not well planned or when borrowing is excessive. Why do people borrow? To pay for education, student loans. To start or expand a business. To buy assets, like a car or home. To cover emergencies. To meet day-to-day expenses when income is not enough. 2. Good debt versus bad debt. Not all debt is harmful. Understanding the difference helps you make informed borrowing decisions. Good debt. This is debt that has the potential to increase your wealth or improve your life in the long term. Examples include education loans, borrowing to pay for studies that increase your earning potential. Business loans, borrowing to start or expand a business that generates income. Mortgage, borrowing to buy a home that can appreciate in value over time. Good debt is usually linked to assets or investments. Bad debt. This is debt taken for things that lose value quickly or don't generate future income. Examples include credit card debt for shopping, luxury items, or entertainment. Loans for expensive holidays. Payday loans with extremely high interest rates. Bad debt often leaves you financially drained because it creates no future returns. 3. Types of borrowing young people encounter. Formal borrowing. Bank loans, for education, business, or personal use. Credit cards allow borrowing instantly but carry high interest rates if balances are not paid on time. Microfinance loans, small loans to support small businesses. Digital loans, fintech apps, quick access but often with high interest rates. Informal borrowing. Family and friends, usually without interest, but it can strain relationships. Moneylenders or loan sharks, easy access but with very high interest and risks of harassment. Community groups/cooperatives, savings groups, SACCOs, borrowing against group savings. Each borrowing option has advantages and risks, and young people must evaluate carefully before taking any loan. 4. The dangers of debt traps. A debt trap occurs when a person borrows repeatedly to repay old loans, creating a cycle of endless borrowing. Many young people fall into debt traps because of poor planning, lack of income, or impulsive borrowing. Signs you are in a debt trap. Borrowing from one source to repay another. Paying only the interest and never reducing the actual loan. Constant anxiety about debt. No savings because all income goes into debt repayment. Real-life example. A young graduate takes a quick loan from a mobile app to buy a phone. Unable to repay on time, penalties accumulate. To cover this, they borrow from another app. Within months, the debt grows bigger than their salary, leading to stress and financial ruin. Lesson: borrow only when necessary and with a clear repayment plan. 5. Principles of responsible borrowing. Borrow for needs, not wants. Take loans only when they will improve your life or income. Understand the terms, read the interest rate, repayment schedule, and penalties before borrowing. Borrow within your capacity. Never take loans that exceed 30 to 40% of your monthly income. Have a repayment plan. Know exactly how you will repay before you borrow. Avoid impulsive borrowing. Don't let peer pressure or flashy advertisements push you into debt. 6. Strategies for debt management. Managing debt is about staying in control and avoiding unnecessary stress. Step 1. Know your debt situation. Write down all your debts, amounts, interest rates, repayment deadlines. Identify which debts are urgent and which are long-term. Step 2. Prioritize payments. Pay off high-interest debts first, like credit cards or payday loans. Always pay at least the minimum on all debts to avoid penalties. Step 3. Budget for debt repayment. Dedicate a portion of your income to paying debt before spending on luxuries. Use the 50/30/20 rule, 50% needs, 30% wants, 20% savings/debt repayment. Step 4. Negotiate with lenders. If you struggle, talk to your lender. Many banks allow restructuring or reduced interest. Step 5. Avoid taking more debt. Do not borrow again while trying to repay existing debt unless it reduces your interest burden. 7. Tools and techniques to get out of debt. Snowball method. Pay off the smallest debts first to gain confidence. Once one is cleared, move to the next until all are gone. Avalanche method. Focus on the debt with the highest interest rate first. This saves you more money in the long run. Debt consolidation. Combine multiple debts into one loan with a lower interest rate. 8. The role of credit scores. A credit score is a rating that shows how trustworthy you are in repaying borrowed money. Many countries use credit bureaus to track repayment history. Good credit score equals easier access to loans with lower interest. Bad credit score equals denied loans or higher costs of borrowing. Young people should start building good credit by paying bills and loans on time, avoiding defaulting on loans, keeping debt within manageable limits. 9. Teaching debt management in schools, coffee clubs. As young leaders, you will be role models in teaching students how to avoid debt problems in the future. Here are methods you can use. Use role play. Act out a scenario of a student borrowing money irresponsibly and show the consequences. Games and simulations. Teach how debt grows when not repaid using simple math exercises. Storytelling. Share real stories of people who fell into debt traps and those who used good debt to succeed. Savings challenges. Encourage students to practice saving so they don't depend on borrowing. 10. Case studies of young entrepreneurs and borrowing. Case 1. Good debt. Mary, a 24-year-old in Kenya, borrowed a small loan to buy tailoring equipment. She repaid on time, expanded her business, and now employs 2 people. Her loan created income and jobs. Case 2. Bad debt. John, a 22-year-old student, borrowed money from different apps to party and buy gadgets. Unable to pay, he was blacklisted by the credit bureau. This ruined his chances of getting a business loan later. Lesson: borrowing can either build or destroy your future. 11. Global perspectives on borrowing. Africa, mobile loans are popular but often come with high interest. Asia, many young people borrow to start small businesses, and microfinance is common. Europe/North America. Credit cards and student loans are major sources of debt for youth. Latin America, community lending groups and informal borrowing are widespread. Understanding these patterns helps you as a young leader relate to students from different cultural and economic contexts. 12. Practical exercises. Debt diary exercise. Write down any current debts you have, repayment amounts, and how long it will take to clear them. Role-play in clubs. Divide students into lenders and borrowers and simulate how irresponsible borrowing leads to debt traps. Repayment plan assignment. Create a simple repayment plan for a hypothetical loan of $500. Conclusion. Debt can be a powerful tool or a destructive force. For young people aged 18 to 35, understanding how to borrow responsibly and manage debt effectively is essential for building a strong financial foundation. As future leaders in financial literacy, you must not only practice these principles but also teach the next generation how to avoid debt traps, use good debt wisely, and achieve financial independence. Debt management is not just about money, it is about freedom, peace of mind, and the ability to pursue your dreams without unnecessary financial burdens. By mastering this module, you are preparing yourself and your community for a healthier financial future.